International transactions, the sales and purchases in foreign currency, and also we're going to learn a little bit about consolidated financial statements with international subsidiaries. Exchange rates between currencies. Markets for the purchase and sale of foreign currency exist all over the world, and in these markets, the United States dollars can be exchanged for Canadian dollars, British pounds, the Japanese yen, euros, or any of the other legal currencies. The price of one currency stated in terms of another currency is called the foreign exchange rate. So these are the foreign exchange rates for various countries in relationship to the US dollar. Sales and purchases listed in foreign currencies. We're going to be primarily looking at some sales, but the purchases would be the same. If the sale terms require payment in a foreign currency, a U.S. company must account for the sale in the accounts receivable using the exchange rate in effect on the transaction date. So if you have a sale with a foreign company and you have to pay them in the currency of that country, then you will have to look at the exchange rate on the dates of the transaction in order to properly value them. So let's look at this. On the date of a sale, the sale to a Mexican company for 10,000 pesos when the exchange rate is 0.0982 on the date of the sale. So the accounts receivable would be 10,000 pesos. The exchange rate is 0.0982. And so it will be valued on the companies of a U.S. company because they have to state their transactions in U.S. dollars would be accounts receivable in the amount of $982. And the value of the sale in U.S. dollars would be $982. And then we have a little T account here on the accounts receivable. Now, if there's an intervening date of a financial statement between the date of the sale and the date of payment, the exchange rate has to be taken into consideration. So let's look at this. We have 10,000 pesos that we have to pay. The exchange rate is this as of the date of the financial statements. And as of the sale date, the value of the transaction was $982. And as of the financial statement date, because there's a different exchange rate in effect on that date, the financial statement, the value of the transaction is $992, which means that there's a difference of $10. So in order to properly have the accounts receivable valued as of the financial statement date at the amount of $992, you're going to have to recognize the fact that the exchange rate means that the value of the transaction has gone up by 10 US dollars, so accounts receivable will go up by $10, and then you will have a foreign currency exchange gain in the amount of $10. Now, if this were the reverse, then you would have a foreign exchange loss, and accounts receivable would be written down by the difference in the exchange rate. So now let's look at the date of payment. So on this date, the exchange rate has gone up again, and they fluctuate daily, so this is not all that unusual. So now the exchange rate is 0.0975, same 10,000 pesos that the U.S. company has to pay out. As of the date of the payment, it's $975, and so we'll have to compare that to the financial statement date, or the amount that is in our accounts receivable. See, as the financial statement date, it's $992, and so now we're going to compare what we're going to pay out based on the foreign exchange rate in effect on the date of payment in relationship to what we have recorded on the books, and the difference in this instance is a negative or a loss of $17, or a devaluation of $17. So let's look at how our T account is shaping up. Our sale date was $982, and then we recognize the foreign currency exchange gain of 10, and now we're going to recognize the fact that we're paying off this accounts receivable. So the accounts receivable will be credited in order to zero it out at $992. The cash the company will actually be paying out based on the foreign currency exchange and effect on the date of the payment will be $975. The difference between between these two winds up being a debit, which will be a foreign exchange loss. And again, we would do the same thing in using different accounts if we were making a purchase. Now let's just talk for a few seconds about consolidation statements with international subsidiaries. Preparing consolidated financial statements when the parent company has one or more international subsidiaries. An example, a U.S.-based company owns a controlling interest in an Italian subsidiary. The Italian subsidiary will maintain its financial records in euros. Before preparing the consolidated financial statements, the U.S. company must translate the financial statements of the of the Italian subsidiary into U.S. dollars. After the translation is complete, the consolidated statements will then be prepared the same as they would be for domestic subsidiaries. Procedures for translating an international subsidiary's account balance are dependent upon the nature of the subsidiary's operations. This requires the parent company to select the appropriate foreign exchange rate and to apply those rates to the foreign subsidiary's account balances. Now, this type of learning about how to do this is beyond a principles class, but I'm introducing the subject so that you'll have an awareness of it and you'll be ready when you see this in your later financial statement courses, your later accounting courses when you come into international subsidiary consolidations.